Welcome to the show. I do want to start with that headline that we just referenced, that U.S. regulators may be willing to entertain the prospect of backstopping losses at these banks to actually see some sort of sale go through. How unusual would that be?
Well, regulators have done that in the past several times. It was a major factor in the savings and loan crisis and in the resolution of that in the early 90s. I personally worked on many, many transactions where the acquiring bank got loss sharing on some of the assets. It helps when the due diligence period is short and you can't really assess what the risks are. It's difficult to price those assets. So loss sharing really makes the transaction much smoother. It fell out of favor in the resolution after 2008. They tried it a few times, but generally they moved away from that and felt there was enough time for the assets to be priced.
So Silicon Valley Bank, we keep hearing that it is such a unique bank, that its loan portfolio is unique, that its assets, that everything about this bank is very unique. And it's been part of the argument by some folks that have been on our air this week to say that, no, this is not a situation that could become a contagion, because it was a very specific scenario that played out around SVB. Now, whether that's true or not, what does it mean in terms of how this sale process is going to go, and who would actually be able to pick up either the bank as a whole or these different pieces of the puzzle?
Well, that's interesting because, in contrast to Signature Bank, which is very much a normal bank in terms of the assets that it has, Silicon Valley had a very specific set of businesses tied to the startup economy. And the challenge for whole bank buyers, this would not be a challenge if you were just buying specific loan portfolios. But if you try to buy the whole thing, you have to deal with the fact that there's a significant piece of the business, not the largest piece in terms of volumes, but the most important, which is the financing for pre-revenue and growth stage startup companies. That financing book would be very difficult for any national bank to acquire. Generally, the OCC, the regulator of national banks, has not liked the fact that those loans aren't underwritten under traditional standards. And so it makes it difficult for a big bank to buy all those loans.
So, Todd, speaking of risky assets, going a bit broader here, you have called crypto money without a purpose. And we're also now in a time where the purpose of the dollar seems pretty darn clear. People like those again. I had been thinking that crypto and Bitcoin prices were kind of a barometer for risk in the market. But in this environment where people seem to want safety, we've also seen crypto surge higher. Does that send a bad signal, a good signal, no signal at all?
Well, I don't think it really sends much of a signal because, quite frankly, the crypto markets are deeply corrupted and really not a good indicator of fundamental value, since they don't actually track any cash flows. And as we've seen, the markets are very easily manipulated. And so I don't put much credence in movements in the crypto markets. I will say that in the case of Silvergate Bank and then later in Signature Bank, large deposit concentrations associated with crypto players played a role there. But it wasn't a crypto crisis in the sense that, FTX was.